Hello and welcome back. We were on deck 2022, question 22, and we had done, let me pull up the Excel. We had looked at, we had calculated part A, the WACC to be used. We had looked at we had represented the additional information in numerical form in our Excel for the sake of calculating our cash flows for the years 2023 to 2027. And last off, we found the demand for the years. If you have not watched the previous videos, if this is your first videos, you need to go back to the first video so that you can be at par. But if we are at par, I guess we can proceed. So we have the demands for the corresponding years. We have the selling prices for the years, the material cost, the labor costs per unit. Remember, these are per unit, and we have the demands. That means that we can calculate the aggregate figures. So down here, we can write cash flows. And the first cash flows we calculate is the initial cash flows. I like doing things in chronological order. So we have initial cash flows. Let's call them initial, cash outflows, because initially you are investing in the machine and you're also investing in working capital. So we represent this. We had already represented the cost of machine. So we can copy paste, highlight that, Control C, Control V. Remember, in the exam room, we are trying to save as much time as possible. So if you already have the data, there's no need of typing it again. You just copy paste. So initially, we invested in the machine, and if I bring up the PDF, we can see the things that we invested in. We invested in the machine, and we also invested in initial working capital. That was note number initial investment, note number 7. The project will require an initial investment in working capital of 20 million, which will be increasing by 5 million at the end of each year to cater for general inflation. So 20 million is the initial investment in working capital. So we can write that investment in working capital. The value is 20 million. Now for accuracy, you convert it into accounting format so that you can it's easy to confuse the zeros, but when you have the commas, you can see that this is 20 million. So once we have the initial cash flows, do we have any other initial cash flow? We don't have any other initial cash flow. So to get the total initial cash flow, here we just get the sum using the sum formula, and we have 120. We can introduce a top border so that it can be visible. So the first step, we are done. We have the total initial cash flows. And remember, these are outflows, right? We can write their cash outflow. These are outflows. So it's going to be negative when you are calculating our NPV. You need to bear that in mind as we proceed. Now to proceed, we have initial. We can now calculate operating cash flows. And we write operating cash flows. It's good to label the parts so that it's clear. So operating cash flows. So here we start off with we can write down the years. Remember, we have 2023 all the way to 2024. You can just copy down this. Control C, come here, Control V. So we have the years. Now the operating cash flows, we begin by revenues or sales. Let's call it sales. Some people call it revenue, some people call it sales revenue. So let's call it sales. So the sales is simply the demand multiplied by the selling price per unit. And the demand is changing, so is the selling price based on inflation. So the sales, we say equals So demand for 2023, which is 27,000, multiplied by the selling price for 2023, which you had calculated up here. There, hit tab. 2024, we have demand for 2024 multiplied by the demand for the selling price for 2024 up here, which is cell D11, tab, right? Then we can drag this to 2027, and we can a shortcut to the reason why you're seeing these hash marks or pounds is because the width of the cell is too small to hold the numbers that are there. So what do? We adjust the width. One shortcut, you can highlight the affected cells, and you type Alt then O C A. That is a keyboard shortcut, and you can see it has automatically readjusted itself to show all the figures in the calculation. So we have sales. This is a cash inflow, so it's positive. Then now we move down. We will look at material costs. So we less material costs. So we can say less expenses. Then we write material costs. So we still have the demand for 2023 multiplied by the material cost for 2023. Then we need this in negative, so introduce a negative before, and then you hit enter or tab. We can format this whole region. Let's just highlight this whole region so that it can be in accounting format by coming here and clicking the comma, and it's going to automatically adjust into accounting. So whereby we have commas and you also have 2 decimal points. Then for 2024 equals, we have the demand for 2024 multiplied by the cost of materials for 2024. Hit tab, and then remember it's supposed to be negative. Write negative. We can drag this all the way to 2027 since they are corresponding. The reason why we did not drag for 2023 is because it was not corresponding because of this column here for inflation, so we couldn't drag. But now here we can drag because, as you can see, they are following each other on top here, and they are also following each other here on demand. So they stand side by side, so we can drag. They correspond. Once you drag and let go, you can see again we have these pound signs, and we can readjust the width of the rows by using the formula Alt O C A, and it automatically readjusts, right? Alternatively, let me just undo it, Control Z. You can do it manually by coming on top here and adjusting the width of these columns like that. But it's good once you at first it's hard to learn these formulas, but once you practice, they come to you automatically and they save you a lot of time. So enroll for the Excel course, and you learn some of these easy formulas. So we proceed. We have material costs. We move down to direct labor costs. By now you know how we are doing this. Direct labor cost equals the selling price on 2023, or the cost per unit in 2023 multiplied by the demand per unit in 2024, and then we can put minus sign for it to be negative. 2024 equals minus demand for 2024 multiplied by the labor costs for 2024. Hit tab, and then we drag it out to 2027. From direct labor, we have incremental fixed costs. Incremental fixed costs, the same, equals minus demand multiplied by fixed cost for 2023, hit tab, equals demand for 2024 multiplied by minus costs per unit, and then we drag it to 2027, right? Once we have the demand, and do you have any other operational expense? Yes, we have depreciation, which we were calculating here. So here we say depreciation, and for 2023 it is minus the value here. So with this one we just have to fill it manually since they are not corresponding side by side. Equals minus that, equals minus that, equals minus. It is good you use cell referencing. By cell referencing is where you say equals cell C22, so that in case you realize maybe you made a mistake here, you do not have to go down and change it manually. So if you realized you made a mistake, for instance, let's take for example the opening balance. We found that we had made a mistake. It was 120 instead of 120 million instead of 100 million. We'll just come and correct this 120. You write million like that. When you change, it automatically changes, and as you can see, these values also changes. So if we had written it down manually or copy pasted it, it would imply that when we realize we made a mistake, we'll have to change here manually, come back, change here, which will waste your time, right? That's why we prefer to use cell referencing. We copy down the data in Excel, and then we reference that data in the calculation. Remember, even in the exam room, you might have done all that, and then someone comes and says that there is an error in such a number. It's supposed to be a different figure, and you end up having to redo your work if you had not used cell references. But if you had used cell referencing, and let's say in the exam room they say it is supposed to be 100 million instead of 120, you'll just come here on top and change 100 million, and when you hit enter, I want you to observe what happens to this depreciation down here. You see it changes, right? It changes automatically. So we have depreciation. So with this data we can now get the net income before tax. Right? And how do we do that? We get the sum of this. We are saying sum because these are in negative. So when you add, it's subtracted. So sum, open brackets, highlight all that, close, hit tab. And then you can drag this all the way to 2027. And you add a top border to make it nice and neat. So you have net income before tax. Then now we are supposed to less the tax. Right? Less tax. So here write less income tax. When we pull up the PDF, we are told that the tax rate, let's get the information where they are telling us about the tax rate. So check note number 6, we are told the tax rate on income and capital allowances is at the rate of 30% per annum. Assume that the tax for a given period is paid in the same year. So we are told that it is 30%. So here we use that 30%. We say equals minus 30% multiplied by the net income, and then you drag to 2027. So that is the less income tax. So here down here we can get, here we misspelled less. So here we get net income after tax. So this is gonna be this plus this drag to 2027, add a top border to make it nice and neat. Then we have the net income after tax. Remember, we are supposed to operate to get the operating cash flows. Remember, depreciation is a non-cash expense. So at the end of the period, you add it back, right, to get the net operating cash flow. So write add back depreciation. It equals minus this figure there. It's minus. We are saying minus because we want it in positive, because we are adding back. Right, we have that. And then so we have net operating cash flow, which is gonna be net income after tax plus depreciation. So we drag this all the way to 2027 and we add a top border. So we have the initial cash outflows, and we also have the net operating cash flows. Now the only thing that is left is the terminal operating cash flows. These are cash flows that happen at the end of the period. And for starters, we are told that on disposal, the machine is going to be sold for 20 million. Let us bring up the PDF. We are told that the machine will be sold, check note number 2, the machine will be sold for 20 million at the end of the 5th year. That is a terminal cost. We're also told, if you look at, where is that? Note number 7, the project will require an initial investment in working capital of 20 million, which will be increasing by 5 million at the end of each year to cater for general inflation. The whole amount together with the periodic increase will, however, revert at the end of the period. So what does this mean? It means that these figures that you invested in working capital, they will be recovered at the end of the period. So we are supposed to add them back. So terminal operating cash flows. Let us begin by disposal of machine. We are told it's 20 million equals this cell B8. You click on B8, 20 million. Again, we have the other terminal. These are not terminal operating cash flows. These are terminal cash flows. So disposal of machine, 20 million. And then we also have the reversion. We call it reversion. Is that how you spell reversion? Reversion of, confirm whether that's how you spell reversion and inbox me. So reversion of working capital invested. So we can call it, you can divide it into two, initial and periodic. So the initial invested we found was 20 million here. The periodic is this, we may not have included it. Hold up. We forgot to include the periodic working capital, investment in working capital, and which is okay because we can just include it. That's the beauty of Excel. Once we find that we did not include it, we will have to add a row here. We can add the row right below the material costs so that we include the periodic investment. If I bring up the Excel, the PDF, we are told which will be increasing by 5 million at the end of each year to cater for general inflation. So how do we add a row? There are two ways, right? We have highlighted this. You can right click. Once you right click, so once you right click, you hit insert, and voila, a row appears. That is the easiest one, and that's the one we are going to use. So you say right, investment in working capital. It is a cash outflow Because what does this involve? We said this involves purchase of inventory, purchase of what else? This purchase of inventory, that's what you're investing in. We also have an increase in receivables, right? When you increase current assets, you have to invest money in that, and therefore it is a cash outflow. When you're increasing revenue, you have to invest more money in it, so it's a cash outflow. So investment in working capital, we are told that it goes at 5 million per year. Pull up the PDF, you'll see 5 million per year at the end of each year. So we are going to write minus 5 million, 6 zeros, right? And then you drag it. Now the beauty of Excel, once you input that, all the figures change. The figures for net income, because net income, we used the formula we calculated as the sum of this whole column, and therefore when you add the negative 5 million, it automatically updates itself. Same to the tax, same to the operating cash flow, and so on and so on. So that is the beauty of using cell referencing. If you are calculating it manually and putting the figures, when you realize that you made a mistake, you will have to redo the work, right? You imagine if you are writing this down using, like, let's say it was a physical exam and you are writing these figures down, and at the end you realize you made a mistake, it will be a nightmare. But in Excel, the beauty is that you just go back, insert the row as we have seen, and insert the figures, and they will automatically update themselves. Even if you had worked it out to the end and found the NPV, it will redo it itself, and we are going to see it as we go forward. So what are the periodic reversion in working capital? It is the sum of all these, but now it's positive because you are making it back. Remember, we said that you revert the working capital at the end of the period because the assumption is all the inventory that you had invested in, you are going to sell it off, right? And therefore it is a cash inflow at the end of the period. So periodic equals minus sum, close brackets, hit enter. So that is the periodic working capital reversion, 25 million, 20 million for the initial. So to find the total terminal cash flows, total terminal cash inflow. So we have forgotten one, we have not put the tax implication. If we pull up the PDF, we are told that when you look at number 6, we are told that the income allowance is at the rate of 30%. Assume that the tax is given for the period for the year. Check out number 5. We are told at the end of the project, when the machine is sold, any gain or loss on disposal will be considered for tax. And that is why we had already calculated the tax credit. Since it was a loss on disposal, the company can claim back the tax. So this has the effect of a cash inflow, right? So it is a cash inflow because when the company is calculating its total income tax for that period, for the end of the period, they are going to subtract this period because they made a tax, they made a loss on disposal. So it has a general positive effect on the cash flows of the company. So we write tax credit. If it was a profit on disposal, it will have a negative effect because they will need to pay tax on that. So we say equals minus, because it was in minus, it's going to be positive. So we put the minus sign to make it positive. So that is the tax credit. So to get the total terminal cash inflow, we sum all this. We say equals sum, close the brackets, hit enter. We can put that. So we have the initial cash outflow, we have the operating cash flows for the period, and we have the terminal cash flow. With this, we can calculate the NPV. Try and calculate the NPV, and when we meet again, we shall do it together. So until then, happy analyzing.